Artificial intelligence has generated some of the biggest returns that we've seen in stock market history. A lot of people have missed out. A lot of people have made millions.
We have people saying, well, I want to get into AI. Is this a good time for me to be doing it?
If you just look at historic data, the drawback potential is serious. The downside is crazy, and we just want to make sure that you have an investment strategy that's supporting your life and goals, because the worst thing that could happen is you're concentrated in one stock, you see an 80% pullback.
Oh, this is a great investment. Okay, that depends on when you got in, when you got out, which most people can't get right. True wealth is something that's going to support you forever, not a bet that happened in 1 year and then you get wiped out the next year.
And the way to not be subject to all of that is to diversify properly by
and really determine the success of your financial plan. Artificial intelligence has generated some of the biggest returns that we've seen in stock market history. A lot of people have missed out. A lot of people have made millions. Now the question is AI a bubble, or is this just the beginning? All right, so AI, it's exciting, it's uncomfortable, guys. I think we're gonna go, really nerdy into some of the numbers out here to answer the question, is AI a bubble, or is it just the beginning? Are we somewhere in between? First, we wanna preface this, a financial plan is so important. If you're a tech, executive or someone that's had tech stock and your balance sheet is now $5 to $10 million and you're in your 40s or 50s, 30s, we see this quite common now. We've seen it all. We've seen, stocks on margin, and one stock can move pretty quickly. You could see a 50% drop like that. So the question is, how important is securing your life by design for the rest of your life? If you're someone that has not invested, if you're a doctor and you've not invested in AI directly, you may be invested and you don't even realize it. The question is it too late, or is this something that should be part of your long-term investment plan? So first of all, everything is individualized toward you. A financial plan should support your life by design no matter what. Missing out or, FOMO, it's something that's real, but ultimately want to predicate that with your values and what's most important to your family and your financial plan. Now, with that being said, let's get into AI. Are we in the beginning? Or are we in a bubble? What do you guys think?
I think if we look at what is a bubble, what has there been a bubble, early 2000s, .com, 2008, mortgages and housing, and fundamentally just high level what it is basically when everything is way overvalued and there are not financials to back it up. So meaning, let's look at the .com bubble. There was a bunch of companies that literally had no profits. There's no cash flow. These valuations of these companies were all being projected on future cash flows, future earnings. I think that things are a little bit different today. Some of that may be true, and there are some characteristics that apply today, but the big difference is the companies that are leading AI right now, aside from OpenAI really, so we're talking the Googles, the Apples, the Amazons, Oracle's in there. These companies are blue chip, large cap companies in the US. So what that means, there's not a lot of debt on their balance sheet. They have a ton of cash. They're very, very profitable. And so that's way different than what we saw 20 years ago. We had these small companies that didn't have those characteristics. So you can make the argument for and against. I would say our general thesis is there's some characteristics, but this is a little bit different. What do you guys think?
I would say the biggest thing, and this goes back to your point a little bit earlier when you say we have people saying, well, I want to get into AI. Is this a good time for me to be doing it? And then we'll look at their portfolio, and they're 75% in large cap sector of their asset allocated portfolio. And large cap primarily right now, the Magnificent Seven, so your Teslas, your Alphabets, your Metas, that's driving a large majority of the growth of that large cap sector. The earnings per share of just those 7 companies between Tesla, Apple, Amazon, the Mag 7, 35% a year since 2016. So a lot of these big companies, like Jamison said, are implementing AI in their procedures, in how they operate. And so when you have someone saying, well, I want to get into AI, but their portfolio is 75% large cap, well, indirectly, you have a ton of AI exposure. You might not even realize it.
Is AI a bubble, or is it the beginning? It's the beginning, and here's why. So now I'm going to preface that with, there's going to be lots of volatility. There's going to be lots of companies, I think, that go under. There's lots of companies that benefit huge long-term, but is AI in general, with how it's going to impact our lives, companies' lives, how companies, print profits, save expenses, generate free cash flow, this is just the beginning. But there's going to be lots of bumps. There's going to be crashes. There's going to be volatility, just like you'd see in a normal stock market. If you're just invested in AI, that's going to be even more magnified. But if we just look at what the bubble, Jamison, going back to what you said, the tech bubble, so from June 30th in 1996 to March 31st of 2000, basically almost a 4-year period, earnings during that period, which stock prices are derived from, were 80%. The returns, if you invested in those companies, were 439%. If we look at a ratio, that's a 5-to-1 ratio of returns over earnings.
Earnings did not support the returns you were seeing.
Now, if we look at today, so from September 30th of 2021 through September 30th of 2025, so, 4-year period we're looking at, earnings growth was 73%. Stock returns have only been 94%. Let's just say a 1 to 1.2 ratio versus a 5 to 1 ratio. Yeah, there's been lots of easy money, but earnings has really supported that easy money because these companies are literally printing cash, and the projects are not taking on debt. They're using free cash flow. At least the Magnificent Seven a lot of times are. Now, are there dangers? Is there a huge concentration like the S&P 500? 35 to 40%, depending on the day. The Mag 7 make up over a third of the S&P 500. So that means 7 companies make up over a third of the S&P 500. 2/3 are made up of the other 400 plus companies. So do we think it's a bubble? No. Are there lots of caution, lots of optimism, depending on how you look at it? Absolutely, yes. Let's dig into some further details.
No, Matt, that's a great point because you were mentioning the build out of a lot of these AI developments are being from cash flow and not debt. Global AI infrastructure investment through 2030 may reach between 5 and 7 trillion, and it's being funded responsibly. They're not taking on debt. These are just through operating cash flow, diversified capital markets, strategic partnerships, etc. So not leverage. So it's not speculative as it has been in the dot-com bubble and the graphs that we just referenced. So the build out of a lot of these infrastructure investments is from a lot more stable sources than we've seen in some of the previous bubbles in the U.S. economy.
Yeah, if you look at like commercial real estate, think about how many people are working from home still post-COVID, and like the vacancy rate, I don't know, like in Pittsburgh, I just know it's over 50% if you're downtown, like as far as like what companies are in person. If you look at these data centers, the vacancy across the board is 1.6%. There's not a demand shortage, there's a supply shortage. The GPU supplies basically get sold out instantaneously, and a lot of the scalers have to turn away workload because of that. Now, with that being said, it's not all butterflies and rainbows here, right? So, Jamison, you have the example of the mortgages that were being used in some cases. So depending on your company, not all companies have free cash flow. Not all companies have good credit. Give us that example.
I think the overarching point is the technology can be right, which we think it is. The technology is revolutionary. Prices don't always have to be right. We're not saying prices aren't correct now. And the companies that we think are going to be the winners are not always the winners. So if you keep those in mind and really take a diversified approach to this, that's how we would say you win instead of trying to handpick which company is going to win. And so to the example that you said, a lot of these companies, and we'll specifically look at OpenAI, Anthropic, and XAI. So these are not part of the Mag 7. These are 3 of the leaders. They're all 3 privately held companies.
And they're supporting the Mag 7, right? But they're not.
Somewhat, yes.
Yeah.
All 3 are privately held companies. All 3, they're not as profitable, have the cash flows as the bigger companies. So one of the big things behind all of this is the infrastructure build out and these push to build these data centers. These data centers are billions of dollars, trillions of dollars, and are flowing into these to build this to support the infrastructure. Those 3 companies specifically, because they don't have the cash flows on their balance sheet, they don't qualify for normal business loans as a profitable company would. So there has been instances where they're underwriting, mortgage type loans just to get the funding into these data centers. And so we're not here to speculate if that's good or bad or how that's going to impact their company. But what I would caution is there's a rush to dump a lot of money into this technology. And if we look back at past revolutions of tech as far back as railroads, radios, the internet, all of this stuff, a lot of these cycles are the same in the sense of people rush to dump their money in. It's euphoric, it's emotionally driven, and then the cycles are very similar. So we're not saying there's going to be a big crash. There probably will be some corrections along the way. And the way to not be subject to all of that is to diversify properly by investing with the tech, not trying to handpick which companies.
Are we on an AI bubble with certain companies? Absolutely. Certain companies will will crash. The overall, are we on a bubble AI? I would answer no. Diversification is an important structure to have in any portfolio. I would say, especially in AI. I mean, their main players are basically exchanging money. Nvidia, Tesla, Amazon, all these companies are basically exchanging money. So there could be some issues, if that stops. But diversification is still going to be an extremely important aspect of AI. And the rest of the S&P 500, as these other companies do start to adopt AI and figure out how it can save, their profits, revenue minus expenses.
And I think it's important to understand, like, if you're heavily concentrated in one of these companies, if you just look at historic data, like, the drawback potential is serious. Like, if you look at NVIDIA the last 20 years, obviously they're killing it right now. They've gone up and to the right, but they've dropped over 50% twice. There's like a 60% pullback and an 80% pullback. So you will get a lot of this upside, but the downside is crazy. And we just want to make sure that, you have an investment strategy that's supporting your life and goals, because the worst thing that could happen is you're concentrated in one stock, you see an 80% pullback, and will that last with NVIDIA? Probably not. They'll probably rebound. They're a big company. But in that short time period, your life's going to be really stressful because it's just depending on the NVIDIA share price.
Yeah. Do you have the time horizon to wait out one of those drops?
Exactly.
And then emotionally speaking, are you disciplined enough to stay in during one of those downturns? A lot of people, it's a lot easier said than done. So that's why we always stress keeping a concentrated position between 10 and 15% of your overall balance sheet, your overall net worth, so that we're not so tied to those swings when they do occur.
Cisco was booming in late 90s, early 2000s. They got crushed with the dot-com bubble. 25 years later, now they're adopting AI. They are now back at the price they were 25. So it literally took them 25 years to get their business back to where it was. So that's like that can happen with any one of these companies.
No question. Yeah. So historical perspective, we had the railroads in the 1840s, big transformation, radio and autos in the 1920s, big adoption, huge drawdowns ultimately at the Great Depression. Then we had the Nifty 50 in the 1970s. So lots of iconic businesses, but extreme valuations. We know the ending story there. And then the internet, 1990s to 2000s. So world-changing tech, 5-to-1 ratio of returns versus earnings. A lot of people got greedy, lost their shirt, 78% NASDAQ decline in those 3-year periods.
Basically, every one of these, same thing happened. The technology is revolutionary. A lot of companies
People get
won
greedy.
and a lot of companies lost. And I mean, none of us were alive 100 years ago, but from my research, it looked like in the 20s, RCA, Radio Corporation of America, is like the equivalent of like a big blue chip AI stock. It rose 200% in the 20s and then it crashed and doesn't exist. So there's so many examples of like trying to pick that one company along the course of history. The Nifty 50 is another good one. There's 50 blue chip stocks that people thought no brainer. That was like Coke, IBM, McDonald's, like put your money in there and don't ever sell them. And that obviously didn't work out.
I go back to just the COVID pandemic. We had a 1-month drop. We saw the market drop 30% in about a month's time. By year's end, we had already made up the difference. A 3-year drop, like, do you have the stomach to deal with a 3-year drop, consecutive years? Do you have the lifestyle that you're able to sustain with your income without having to take any distributions? I think it's so much easier said than done. So, I mean, do you really have the stomach for that 3-year stretch where that market could go down? It's easier said than done. Oftentimes, people say they can, but in the moment, it's hard.
If you're in the tech bubble like before, and that's all you were in, which a lot of people were just in tech stocks, they were so hot. We talked about that 5-to-1 ratio. They're so hot. Let's say you've got $10 million. So to put it into kind of today's perspective, like a lot of these tech executives have, you see a 78% decline. Like it happened in 2000 through 2001. Your 10 million is now worth 2.2 million because of that 78% decline. But if it goes back up 78%, it's only 78% of 2.2 million. So, we're still missing way over half our money. It would take a 450% return after that. You'd be back up to 9.9 million. You wouldn't even be back up to the 10. So drop of 78, even if you go up 450%, 2010, they call it the lost decade. So you're kind of out of luck for those 10 years. You're waiting. So the point is, yes, you want to participate in these big swings, but just as much as you want to get these big returns, you got to protect, the negatives that can take, you get 10 over 10 years. That's great. You drop 50%, you just gave it all back.
I found this interesting, the Cisco numbers. It went up 3,800% in its peak, and then it dropped 90% of that. And then it took them 25 years to get back up to that.
Back to even.
Yeah.
Yeah. So, this is a great investment. Okay, that depends on when you got in, when you got out. Yeah, so which most people can't get right. So someone that invested in the bottom and rode it back up could be great. Someone that was in it for 20 years and then took a huge loss, it could have been the worst investment of their life. So a stock's not a good investment plan. You have to have diversification, asset allocation. You have to have a plan. True wealth is something that's going to support you forever, not a bet that happened in 1 year and then you get wiped out the next year.
And this is strictly financial. We're not even talking about the behavioral side of this too. If you look at the S&P 500 return over a 20-year period from 2000 to 2019, would have had about right around an 8% return. The average investor at that same time frame only averaged like 4%. So even if you got it right twice, did you have the discipline to not touch it over that 20-year period when you shouldn't have? When the market's down, did you stop? So financially, you can make the right decision, but behaviorally, are you following the discipline plan that you set in place? A lot of people don't.
To further that, if you're an accumulator, most people don't have the discipline. But if you're in the distribution mode, there is no waiting it out. There's the emotional, but then there's the actual. The actual is if you're distributing money and this is happening, you're just going to run out of money. So you got to diversify, you got to asset allocate. Anything before we go to kind of a review of our core investment philosophy, do you guys have anything else to add? I know we've talked a lot about numbers, a lot about statistics. We're not in a bubble, but we are very cautious and optimistic. Long term, it's here to stay. How you invest in it, how much you invest in it can really determine the success of your financial plan.
Yeah, I'd say there's like kind of two ends of the spectrum of people that try to get this right. Is you have like the emotional side of like, hey, this is revolutionary, these companies are really great, yada, 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 and there's no like fundamental backing of it. And then there's the other side of people that try to like analyze the business fundamentals and look at Sharpe ratios and price to earnings ratios, and like the smartest people in the world that try to figure the technical side of this out still don't get it right. So neither one of those will generally be a good approach. The truth's generally somewhere in the middle. And so it's really just design a plan that no matter what happens, it's going to be there to support your life.
Yeah, I like the quote, nothing is ever as good or as bad as it seems. So is AI as good as it seems? Probably not. Is it as bad as it seems? Probably not. Yeah, but obviously it's life-changing, but if it's going to change your life and your investment plan, you got to stay disciplined, not get too greedy, but also not have fear around it either. So that brings us to our investment philosophy. So we've got to participate in long-term innovation. We've got to be able to survive inevitable drawdowns. If you're in accumulation and distribution mode, those are two separate things. One, you have more flexibility than the other. And we got to keep your life goals on track. So we want to make sure, does your balance sheet support your life by design? And so, we're going to stay globally diversified. We're going to make sure you have safe assets to survive a total stock market downturn, not just AI, but in general, if you just look at, indexes right now, generally speaking, whether you like it or not, you're going to be, would say, overweight AI. And that's something we've leaned into, obviously being in the semiconductor ETF for several years now and having a focus on technologies has paid off, and we're diversified around it. So if there are downturns, then, we've got the financial plan, the portfolio that can weather the storm, and it's really an all-weather portfolio. Any questions, please reach out. Yeah, we're excited to continue to track this and make sure our clients participate on the upside and protect on the downside.